Let's practice double entry counting using the GoVenture Entrepreneur Business Simulation. So here we are, we're going to start our business. We're going to do an ice cream kiosk. And as we run our business, we'll be prompted to enter our double entry accounting postings. So where we're at here was we just started our business and we needed some seed financing. Seed financing is money used to start a business. And so in this case, its system is telling us that we invested $8,000 in cash of our personal savings as startup capital to open our business, and in return for the equity in the business. What that means, equity means the shares or ownership of the business. So we own the business 100% and we're putting $8,000 in cash in return for the ownership of the business. The other option would have been to do it as a loan, but here we're doing it as equity. So let's post this transaction. Remember, double entry counting, there's always at least 2 postings that you have to do. That's why it's called double entry. Sometimes it's more than 2, but it's always a minimum of 2. So we have to decide, all right, well, what's happening here in this transaction? Well, we're getting $8,000 in cash, so we're going to, from our cash, we're going to choose the cash account, and we're increasing cash. So an increase in an asset is called a debit as opposed to a credit. So here I would keep it as debit, and I would enter the amount of money coming in, which in this case is $8,000. So there's our cash represented. Now, what's the other side of this posting? The other side of this posting is revealed here, where it tells us what we're getting in return for that $8,000, and it is equity. So let's scroll down here and look for equity, and it says startup capital. Now there's another one here called capital from shares sold. That's normally used if we're going to sell shares in the future, but on startup it's startup capital, so that's what we're going to choose. And we're also going to now choose a debit or credit in this example. And now we have to choose whether this is a debit or credit. So we're actually increasing startup capital because initially it's 0 in the account. All of our accounts are 0 when we first start, and we have to show an increase of $8,000 in startup capital. So as an equity account, an increase is represented as a credit. So we're going to do 8,000. So that's one of the things you just have to remember in accounting is what type of accounts are debits and what kind are credits. And there's 5 different types of accounts: asset, expenses and cost of goods, liabilities, equity, and revenue. So there we go. We've got a debit, an increase of cash of $8,000, and an increase of startup capital of $8,000, which is in this case is represented as a credit. So we can post this. Now before I post it, I'll note that there's 2 other buttons, hint and show answer. So hint will give us a hint as to how this should be posted. It won't give us the answer, it'll just give us some helpful information to guide us to the answer. If we're totally stuck and unsure and we want to keep playing, we can do show answer and it'll actually post the answer for us. But I'm going to post it here. And success. So great, we've got it. So we've got our startup capital or seed financing identified. So let's choose a name and a logo for our business. So I'm going to call it MG, and this looks like a nice ice cream logo. So I'm going to choose that. And now we're going to buy a kiosk. We're going to choose a location first. So we're going to go to the shopping center, say OK to that. And we've chosen, we're going to have to choose our kiosk or buy our kiosk. And it's telling us that our kiosk is going to cost $3,000. So let's post that transaction. Well, if something's going to cost us $3,000, that means we're going to pay $3,000. So our cash, in this case, is going to be reduced by $3,000. So a reduction in cash is a credit. So there's our $3,000. And what are we going to adjust? What are we going to balance with that? Well, a kiosk is a physical item. It's a physical asset. And so because it's a physical asset, it would be classified in the list of accounts that we have here as property, equipment, and startup. So it's actually equipment. So it's an asset that's equipment. And when we increase an asset, we debit it. And so we're going to debit the $3,000. So basically what we're doing is we're moving $3,000 of value from cash by reducing cash, crediting cash, and moving it to be an asset, a debit of $3,000. So let's post that. Success. Great. And we had to register our business with the government. We qualified for permits and a variety of business startup services. Now, in some businesses, you could classify these as expenses. Other businesses might choose to classify these costs, these startup costs, as assets. And it's a bit of a gray area which approach you choose, but in this simulation, it's telling us here that we're going to treat them as an asset. And it's doing that, by the way, because it simplifies the simulation from a learning perspective. It's classifying it as an asset. Let's post this transaction. So we're paying money again, so our cash is being reduced, which means crediting cash of $2,000. And we are adjusting another account, which is an asset account, because it says we're posting it as an asset, and I can find it here, property, equipment, startup asset. And that's going to be debited by $2,000, the same amount. So there's our double entry accounting. Let's post that. Success again. All right, and then we choose our kiosk because we already paid for the kiosk. There we go. So we're all set. We've got our startup decisions, and now what we need to do before we open for business is actually review our products. I can see I've got an ice cream sundae, an ice cream cone, an ice cream bar. I can see what each of these products is made of. So to sell an ice cream sundae, I need 2 scoops of hard ice cream with toppings served in a container. So that's 3 different items that are needed to make the sundae. An ice cream cone needs 1 scoop of hard ice cream and a cone. So we need hard ice cream and a cone. That's 2 different items. And this is a pre-made, the ice cream bar is pre-made, ready to serve ice cream bar. So that's just a single item. So if I go to my inventory, I can see the items that are used to create these products, but I have no quantity. There's nothing because I've just started my business. I don't have anything. So what I need to do is I need to review suppliers from which I can order that inventory. And I have 3 different suppliers. Low is low prices, satisfactory quality. All good, premium quality and prices. That means high price. And Value Mart is somewhere in the middle. So if I go to order inventory, maybe I'll choose Value Mart somewhere in the middle to get started. And I can see what Value Mart's prices are, which might be different than low. In fact, we know low's prices are going to be lower. But let me choose Value Mart, and I can choose a quantity of items to order. So I can either click these buttons here, or I can click these quick quantities that'll give me some discounts as well if I jump to some quick quantities. All right, so let's buy this inventory. Now to buy it, I can see the total cost is going to be $85, and I'm picking it up. So it's not being shipped or delivered, so there's no cost for that. So I can get this inventory immediately for $85. Let's buy it. Great, we purchased it. Guess what? Triggers a financial transaction, right? We just done something that adjusted the value of our business in some way or moved value. And in this case, it's moved $85 in cash. So we've got to move cash. So we're going to reduce our cash of $85.12. And we're getting inventory. So the inventory is an asset. And so we're going to record that by an increase in our inventory asset of the same amount of money. That's the value that we've moved from cash to inventory asset, and we're going to post it. And there we go. And so now what happens is we just keep playing. So now that we have inventory, we can actually open for business. Let's check our work schedule first. It says 9 to 5. I'm going to make this a short day just for today. So we're going to choose, let's say, 12 to 3, just to make it a quick day. And let's open for business now. There we go. We're open for business, and we can see customers are coming into our ice cream kiosk, and lots of nice bells going off, which tells us we're making sales, and we can see lots of sales happening. And the clock is moving, and we're almost at the end of the day. And we'll see what happens. So these customers have given us money. We've sold our product. We've given them product. They've given us money in return. And now we have to record this transaction. Now notice here, there's actually 4 entries we have to make here. Why is that? Well, there's a few things going on here. So our customers gave us money, which is called sales revenue. Here it is, $134. That's how much money our customers have given us. And there's a cost of goods. So the ingredients that we used to make the products that we sold for $134 are considered cost of goods. And that totals $48.64. Now remember, cost of goods only represents the inventory that I used to sell these products that I earned $134 with. If I still have other inventory unused, other ingredients that I have not used to create products, that's not sold yet. That's still an asset. We're basically just taking the amounts that we used to actually make the sale. So let's post this transaction. So first of all, let's do the good one here. We got cash, right? Customers gave us cash. That's wonderful. So we're going to increase our cash. We always love increasing our cash in business. So that's the debit. So let's put 134 for that amount. So we've received increased cash of $134. Now, cost of goods, we have to record. So cost of goods is a COGS account. COGS is short for cost of goods sold. And it is production and inventory. And so we're going to now debit our COGS, because debiting a COGS account means increasing the account by the amount of money. So that's $48.64 that we used up of our inventory. Now, the other thing we have to do is we have to adjust our inventory, because we took $48 of value from our inventory asset. These are ingredients that were in inventory and recorded as an asset. We took that value and we made a product and gave it to a customer, which means we no longer have that in our business. It's gone. The customer took it with them. So our inventory is now less valuable than it was before we did that. So we have to actually reduce our inventory. So we're going to look at our asset inventory, and we're going to reduce it by the $48.64, because we have that much less value held in inventory at this time. So we're reducing our inventory by posting it as a credit. And then finally, we've got our $48 balance. There's two entries here for that. We're missing the 134 entry. So this is going to be the 134 entry. And that is our revenue, our sales revenue. So that's a revenue account of sales. So customers gave us 134 cash, but how do we record that cash? We record it as revenue. It wasn't a loan that somebody gave us where we borrowed money. It wasn't that kind of money. It was sales. So we record that as sales. And when we increase our revenue account, that means crediting it. So we're going to do 134 for that. So you'll notice there we have a debit of 134 and a credit of 134 balanced. A debit of $48.64, a credit of $48.64 balance. So all four of these balance out to zero, and we can post it, and success. At the end of the day, we also had something else happen. Some of our inventory spoiled or got damaged. So this is not included in the cost of goods that we used to make products purchased by customers, because if it wasn't any good, we wouldn't be able to sell it to our customers. So this is additional inventory that spoiled or got damaged along the way, and we have to record that. Now, how do we record that? Well, it's an expense. So it's a loss of value of our inventory asset, and it's recorded as an expense. It's not a cost of good, again, because the customer didn't take it with them. This is just thrown away, gone. Value is lost. So our inventory gets reduced, which is a credit, of $1.60, because there's $1.60 worth of inventory that is now gone, cannot be resold, has no value. And then we're going to increase an expense for inventory spoiled or damaged, and increasing the expense means debiting it for $1.60. So there's our credit and our debit, and they balance. Let's post it. Great, so that's the end of the day. We can also see here a summary of our end of day results with all the numbers, and now we can repeat this and continue to run our business day after day. And a lot of these transactions that we've just practiced, we're going to repeat day after day. Every time we buy inventory, we're going to incur a transaction. When we end up deciding to hire employees, we'll incur a financial transaction and have to post it. When we do marketing, if we purchase advertising, we're going to have to post that transaction. The startup transactions we post at the beginning, we won't have to do again, because that was only part of startup. It was a one-time thing. These other transactions are happening in the daily operations of our business, and so we're going to have to keep making those transactions. And remember, every post that we make here is actually feeding in to our general journal. So every transaction as it happens will be visible right here in our general journal. In fact, you can see it. It's in reverse date order here. There's the $134 in revenue and sales, so it increased our cash. Our revenue, sales was increased, our cost of goods was increased, and our asset was decreased. So all those posts, you can see them right here in our general journal. And we can also bring up our ledger, which categorizes accounts in a little bit of a simpler way to look at them. And we can see, for example, just the cash account and the transactions related to the cash account here. So we can follow everything that we did is recorded in these two documents, and then these documents are used to generate reports like income statement and balance sheet and so on. So there you have it. Go ahead and practice double entry accounting with GoVenture Entrepreneur.